Okay, I want you to picture your own neighborhood for a second. You know, the coffee shop, the sidewalk, the traffic. Now, imagine if the population of your city didn't just double, but, well, it multiplied exponentially over 12 months. We're looking at a city of roughly 2 million people having to absorb 12 million visitors in a single year.
It just sounds like a logistical nightmare, doesn't it? But that is exactly what happened in Montreal in 2025.
12 million. It's a number that feels so abstract.
Yeah.
Until you try to get a dinner reservation or, walk down St. Catherine Street without bumping shoulders with three strangers.
Right.
We're looking at the report, Tourism, 2025's record-breaking results and the future of the metropolis. And honestly, this isn't just about selling T-shirts and poutine. This is about a city's entire metabolism changing.
That's the perfect word for it, metabolism. Because when you have that volume of inflow people, money, demand it physically reshapes the organism. It changes the architecture. It changes the real estate market.
And the daily friction of just leaving there.
Exactly.
Yeah.
The daily friction.
And that's what we're diving into today. Not just the victory lap of, hey, we broke a record, but the messy, fascinating reality of what happens when a city gets this popular. We have to talk about the $5.2 billion that changed hands, this concept of bleisure that's apparently changing how condos are built, and the very real tension between tourists and the people who actually, pay property taxes there.
And it's a tension that really defined 2025. But before we get to the friction, we have to respect the sheer scale of the surge.
Okay, let's start with that 12 million number, because in the report, they call it reaching new summits. But to me, that sounds like corporate speak for we were absolutely slammed.
It was a stress test, essentially. To give you an idea of the pressure, just look at hotel occupancy. The year-round average was 72%.
72%, which sounds pretty good.
It's very healthy. It's profitable. But
Yeah.
averages are dangerous because they smooth out the peaks.
Right. Nobody cares about the average on a Tuesday in February. They care about July.
Exactly. During festival season and the Grand Prix, occupancy hit 90%. We need to pause on that figure. When a city hits 90% occupancy, the market, it effectively breaks.
How so? What do you mean breaks?
Well, there's just zero elasticity. If you're a traveler trying to book a room last minute, you aren't paying the standard rate anymore. You are paying 3-4 times the normal price.
Yeah.
That's when you see, a standard roadside hotel charging $800 a night.
Because the algorithms just know there is literally nowhere else to go.
Nowhere.
So that $5.2 billion in tourism spending, a lot of that is coming from that compression, just people paying a massive premium to be there.
A significant portion, yes. That $5.2 billion is a massive injection of liquidity. But the interesting part, and the part that usually gets lost in the headlines, is where that money goes after it hits the hotel register.
Because the cynic in me, and I think the cynic in a lot of listeners, assumes that money just flies off to corporate headquarters somewhere else.
Some of it does, sure. But the tax revenue generated by 12 million people is enormous. The report highlights that the city and government poured $150 million back into modernizing infrastructure. And this is where it gets really interesting for the locals. They aren't just filling potholes.
They're fundamentally redesigning the streets. You're talking about the pedestrian zones, right? Like Montreal and St. Catherine.
Precisely. Think about it as infrastructure as a yield-bearing asset.
Right.
The city is betting that if they widen the sidewalks, ban cars for the summer, and make the street a destination, the tax revenue from the increased foot traffic will outweigh the cost of the concrete.
So in a weird way, the tourists are subsidizing the quality of life for the residents. The reason you have a nice walkable promenade to push your stroller on in October is because 12 million people spent money there in July.
That is the feedback loop. It's the tourism tax working in the residents' favor. But of course, that only works if the experience stays good enough to keep people coming back. You have to feed the engine.
And the engine in Montreal seems to be running on two very different types of fuel. You've got the high-end luxury crowd, and then you've got the sort of mass entertainment crowd.
It's a total bifurcation of the market. On one end, you have the Formula One Grand Prix.
The heavyweight champion.
Oh, without a doubt, over 300,000 visitors for one weekend. But functionally, F1 is an island. It brings in a very specific demographic, high net worth, international, luxury-focused. They land, they spend an incredible amount of money on hospitality, and they leave. It's a massive short-term cash injection.
Which contrasts pretty sharply with something like the Jazz Fest or Les Francos.
A completely different animal. Between the two of them, you're looking at 1.5 to 2 million visitors. But this is the soul of the city. This drives volume to the Quartier du Spectacle. It's less about, $10,000 bottle service and more about 2 million people buying dinner, drinks, and merchandise. It creates a baseline vitality.
Right. And then you have Oshéga, which I feel like we often dismiss as just a festival for kids, but the report flags it as a major economic driver.
It is, and it's because of where the attendees come from. You have 120,000 to 150,000 people, but a huge chunk of them are non-Quebecois. They're flying in. And when you fly in for a festival, you aren't just buying a ticket. You're booking a hotel for 3 nights. You're using Uber. You're eating out 3 times a day.
The import value is really high.
The import value of that attendee is very, very high.
It's interesting you mentioned that because that brings us to the demographics. Who actually were these 12 million people? The breakdown was a little surprising to me.
Yeah, it really challenges the stereotype that tourism is just, Americans and Europeans. The backbone of this whole boom was domestic. 8.8 million visitors were Canadian.
That's almost 3/4 of the total.
It is. And specifically, we saw a 17% surge from the Atlantic provinces.
A 17% jump. That's massive. What's driving everyone from the East Coast to Montreal?
It's likely a combination of things. Accessibility, the relative cost compared to flying to Europe or the U.S. and Montreal, serving as the nearest big city cultural fix. It's the staycation trend expanding to a regional level.
So people are traveling, but they're staying a bit closer to home.
Exactly.
But looking internationally, France is still showing up in a big way.
Record numbers, 470,000 visitors. The cultural and linguistic bridge is stronger than ever. But the U.S. numbers, they tell a more complicated story.
Right. The report mentioned a 5% dip in American visitors. Is that just the economy?
It's the geopolitical climate, economic uncertainty. Fewer Americans are crossing the border. But, and this is the key part, the ones who do come are spending more per capita than ever before.
So we lost the budget traveler from the U.S., but kept the luxury traveler.
Essentially, yes. The casual road tripper might have stayed home, but the traveler with disposable income still came. And that actually links to the most critical economic divide in the whole report, the business traveler versus the leisure traveler.
Okay, this was the stat that made me just stop and reread the page. We have to break this down.
It's the Pareto principle on steroids. You had 11 million leisure travelers people here for fun, and you had roughly 940,000 business travelers people here for conventions, mostly at the Palais des Congrès.
So business travelers are less than 10% of the total headcount.
Correct. But those business travelers generate 63% of the total economic value of the meetings and convention sector.
That is wild. Less than 1 million people are doing all the heavy lifting for the economy.
It all comes down to behavior. A leisure traveler, books maybe 50 days in advance, stays in an Airbnb, looks for cheap eats. A business traveler, their company books them 6 to 18 months out. They stay in 4 or 5-star hotels. They have expense accounts.
They're not price sensitive in the same way. They're the whales.
They are the whales. And the city is desperate to catch them. But the lines are starting to blur. And this is where we get to that buzzword that everyone loves to hate. Bleisure.
Business plus leisure. It sounds like a bad marketing pitch, but the report says it's actually changing the physical landscape of the city.
It's not just a buzzword anymore. It's a dominant behavior pattern. You have a delegate coming in for a conference on a Tuesday, but instead of flying out Friday morning, they stay until Sunday. Maybe they bring their partner.
And now you have a hybrid trip.
Exactly. And just think about what that does to accommodation needs. If you're staying for 3 nights, a standard hotel room is fine. But if you're staying for 7 or 10 days and you need to log into Zoom for part of it, do you want to sit on a bed with a laptop?
No, you want a kitchen, you want a living room, you want a separate workspace.
Right. So this demand is fueling a construction boom in apart hotels and high-end rental condos, specifically in areas like Griffintown and the city center. Developers are realizing that the standard 300-square-foot hotel room is obsolete for this demographic. They need to build units that function as temporary homes.
But this is where the friction comes in, isn't it? Because if you're building temporary homes for tourists in Griffintown, what happens to the permanent homes for residents?
That is the core conflict. We are seeing neighborhoods like Quartier de Lumière and Griffintown in a state of flux. They are becoming, for lack of a better term, resort zones. And while that's great for the tourism numbers, it puts immense pressure on housing availability.
And it feels like a missed opportunity, too. The report mentions a gap in hybrid real estate.
It does. We have all these people wanting to do workations coming for 2 to 4 weeks, but the market hasn't fully caught up. We have hotels, and we have residential apartments. We don't have enough high-end, dedicated co-living spaces where a professional can land, have a fully equipped office, and a luxury living space without kicking a local resident out of their apartment.
Which brings us to the elephant in the room, short-term rentals, Airbnb.
It's the double-edged sword of modern tourism, isn't it? On one hand, the sector supports 50,000 direct jobs. That is, 50,000 families in Montreal putting food on the table because of tourism. You cannot just ignore that.
But on the other hand, you have residents in the Plateau or Old Montreal who feel like they're living in a hotel lobby.
Exactly. The report is very candid about this social cost. When commercial success booms, cost of living rises, your local coffee shop gets more expensive because it can charge tourist prices. The housing stock gets chewed up by short-term rentals, driving up rents for everyone else.
So what's the fix? Because you can't just put up a wall and say no more tourists.
The strategy the city is pushing is called neighborhood tourism, or decentralization.
Which basically means trying to convince tourists to leave the old port.
Yes. The goal is to take that mass of 12 million people and spread them out like butter on toast. Tell them to go to Verdun, go to Hochelaga, go to Rosemont.
Okay, but playing devil's advocate here, does the resident in Verdun want that? If I'm living in a quiet neighborhood, do I really want it to become the next tourist hotspot?
It's a completely fair question. There is a risk of gentrification spreading outward, but the counter-argument is economic distribution. Right now, a huge percentage of that $5.2 billion stays in a very small radius downtown. By pushing tourists to the boroughs, you are injecting revenue into small, local businesses, the independent bakeries, the local boutiques that might otherwise struggle.
And I guess from a visitor perspective, it's a better experience. Standing in line for an hour to get into a famous bagel shop downtown is miserable. Finding a hidden gem in Rosemont feels like a discovery.
It aligns with the search for authenticity. Tourists today, especially that bleisure crowd, they don't want to feel like tourists. They want to live like a local. So giving them access to real neighborhoods satisfies that demand while relieving the pressure on the downtown core.
So looking ahead, the report outlines a strategy for 2026, and it seems to hinge on three things: cycling, brains, and weather.
Let's start with the cycling. This is a fascinating intersection of sport and real estate. Montreal is hosting the 2026 UCI Road World Championships.
Which is huge. That's like the World Cup of cycling.
It is. But look at the infrastructure investment required for that. The city is expanding the cycling network aggressively. And what we are seeing is that proximity to the RV, the express bike network, is becoming a primary driver of real estate value.
It's the new subway line.
It really is. 10 years ago, you looked for a condo near a metro station. Now you look for a condo near a protected bike lane. It completely changes the desirability map of the city.
Then there's the knowledge tourism aspect. The report seemed a little critical here, like we're leaving money on the table with those scientists and business delegates.
We are failing to convert. That's the harsh truth. We bring in 940,000 high-level delegates experts in AI, life sciences, aerospace. They come, they hold a conference, and they leave.
And we want them to stay.
We want to recruit them. The strategy for 2026 is to use these congresses as a talent funnel. If you have 500 top AI researchers in the city for a week, you should be aggressively pitching them on why they should move their lab to Montreal. It's about turning a 3-day visitor into a 10-year resident.
It's playing the long game. Instead of just wanting their hotel money, we want their tax base.
Exactly. It's a shift from a tourism economy to a knowledge economy.
And finally, the weather, the eternal battle against November.
The shoulder seasons, April and November. Traditionally, these are dead zones. Hotels are empty, staff get laid off.
It's gray, it's raining, it's slushy. It is a very hard sell.
It is. But the goal is to break that seasonality to solve the labor shortage. If you can use culinary events, indoor festivals, and yes, even late-season cycling to fill hotels in November, you can offer year-round employment.
That makes a huge difference for the workers. You aren't hiring and firing every 6 months.
It stabilizes the entire industry. Stability attracts better talent, which leads to better service, which brings back more tourists. It's all connected.
So if 2025 was the year of, oh my God, everyone is here, what is the theme for 2026?
If 2025 was the comeback, 2026 is being framed as the year of co-creation.
Co-creation. That
Yeah.
sounds very utopian.
It is optimistic. But the idea is moving away from the antagonistic model, tourists versus residents, to a shared model. The logic is, if we build great bike paths for the World Championships, the locals get to use them for the next 20 years. If we revitalize a neighborhood for visitors, the locals get better amenities.
So the visitor becomes a partner in building the city, rather than just a consumer of it.
That is the goal, a symbiotic relationship where the influx of capital funds the lifestyle that the residents want to live.
Before we wrap up, I want to ask you about one thing that wasn't explicitly in the stats, but it feels like it's coming. We talked about green infrastructure.
This is the provocative thought I want to leave listeners with. We're seeing a massive rise in eco-conscious travel. Travelers are beginning to track the carbon footprint of their trips.
Right, flight shaming is a real thing.
It is, but extend that to accommodation. In 2026 and beyond, we might see a market shift where a building's green certification becomes a higher value driver than its location.
That's a bold prediction. I mean, location, location, location is the first rule of real estate.
It might become efficiency, efficiency, location. Imagine a world where a traveler chooses a hotel in a peripheral neighborhood, because it's net zero, over a luxury hotel downtown that isn't. If that happens, the real estate map of Montreal gets rewritten all over again. The value shifts to the buildings that can prove they aren't hurting the planet.
That would completely upend the market.
It would. And with the investments Montreal is making, it might be the perfect testing ground for it.
It's definitely something to watch. It's funny, we started this conversation talking about 12 million strangers, but by the end of it, it feels like we're talking about neighbors we just haven't met yet.
Or at least neighbors who are helping pay for the sidewalk.
Exactly. So next time you see someone staring confusedly at a map on a street corner, maybe cut them some slack. They're part of the engine. Thanks for taking this deep dive with us.
Always a pleasure.
We'll catch you on this one.